Hello and welcome to Switzer Investing. I'm Peter Switzer, and tonight I'm coming from London and I'm wearing a shirt because it really is actually hot in London. On today's program, we have Anthony Doyle from Fire Trail Investments, and Paul Rickard talks to him about the very important meeting at the end of this week at Jackson Hole, Wyoming, where the central bankers of the world get together and talk about really important things like raising interest rates. Could they create a recession? All those sorts of things. And business and financial journalists, as well as fund managers and major players in the stock market and the bond market, listen to every word these guys say at this conference. So it's a really important conference and it can move stock markets. And then Raymond Chan of Morgans talks about the second half of reporting season, the trends regarding company earnings and the companies that he likes. And he particularly talks about CSL and Santos. Now, just before we kick off, let's have a look at a couple of things worth making notes on. The market today started the week on a negative note. The index dropped sharply at the start of trade, and you can blame a negative Wall Street lead for that. The ASX 200 index was down 0.9% or 64 points to 7,050. Every sector was in the red except healthcare, which was pretty well flat. Consumer, tech, and real estate stocks really copped it. But the troubled EML payments, which I've talked about quite a bit on the show, was actually up 9.2% after it cut its after-tax losses from a big $28.7 million last financial year to a low $4.8 million. This company is always in trouble, particularly with the Bank of Ireland for reasons I've explained in the past. But to see that the company is actually on the improve partly explains why I've always kind of stuck with this company, despite the fact that its continual bad news items have affected the share price. It's going to be very interesting to see how this company performs in the future. The new CEO is actually basing herself, that's Emma Shan, in London, and that a lot of their business is overseas, so it could actually work for them. The health insurer NIB had a good day, up 7.6%. It reported really well. Pilbara Minerals was up 4.2%, which means that the loving of lithium continues. Adbri, which is the old Adelaide Brighton cement business, was down 17.7% today after reporting a 15% drop in half-yearly profits. Magellan also lost 11.2%, but it did go ex-dividend, and Reliance Worldwide was down 7%. That's a good business. You'll see a lot of these building businesses are not doing all that well because rising interest rates can affect their businesses. Also, rising input costs because of the pandemic and the lockdowns have affected a lot of these businesses. An interesting one was Nearmap, up 5.3%. Had a big rise last week, but it's got a $1.6 billion takeover from a private equity firm called Thoma Bravo, and the company's sort of supporting it. Ampol was up 2% after doubling its dividend. Nick Scali also had a really good time. Now, this is a retailer, and retailers aren't all that favoured at the moment, but he reported very well. Shares are up about 3% to $10.32. And what else we've got there? I think that's probably the main stories of the day worth talking about. The Star Entertainment Group reported a loss of $199 billion, and its share price was down about 2%. Now, in today's Switzer report, I argue we've seen a sneak preview of what happens to tech and growth stocks when the interest rate cycle ends or appears to be ending. We've seen it with our market, once down 15% in June or to June, and now it's down only 7%. The US market was down 24%, and now it's down 15%. And that was all because of the improved outlook for interest rates. So these rebounds actually shows what happens when the market thinks interest rate rises are pretty well over or are bound to end pretty soon. The sell-off today on our market was linked to a new view in the US that came out on Friday, basically, that rates still might go higher. But let me tell you, that's just guesswork. September 13 is going to be the really important time. That's when the next inflation number comes out. And if it's lower than 8.5%, the market will like it. At the moment, there's toing and froing, and there's also profit takers who've done really well because of those market rebounds. This is going to be an untrustworthy period to be worried about stocks. Quite frankly, if the market goes down 3 or 4%, I'm going to be a buyer of the stocks, of stocks I like. And what kind of stocks might I be buying? I might buy losers. In actual fact, it's a pretty good strategy to buy losers today, which will be winners tomorrow. Bob Dylan, in a great song called Times Out of Change, he said, and the losers today, tomorrow will win. But when it comes to losing stocks, I like to bet on quality losers, and it's a great way of investing for those who are patient. Let me give you one easy example to prove my point. When the coronavirus crash happened, the CBA is our best bank by miles, and one of the best banks in the world, fell to $60 and is now $100. Those people who took the bet that this was a quality loser, but one day would win again, they've got a 66% return in the space of less than 2 years. And those who bought CBA then are getting a dividend of 6% plus before franking credits. Yep, Bob Dylan was right. Tomorrow, the losers will win. And I think as long as you're buying quality, it's a pretty good strategy. Now, let's get on with the show. Paul Rickard talking to Anthony Doyle.
Later this week, the US Federal Reserve meets in Wyoming at Jackson Hole for its annual think tank or sojourn, where it talks about what's going to happen in the markets coming up and releases a statement on Friday. That'll be a big event in the US on Friday because people will be looking for signs about what the Fed's thinking about inflation and interest rates. But to join me now to discuss that and also his outlook for the more local conditions and a couple of interesting stocks, I'm joined by Anthony Doyle, the Head of Investment Strategy at Firetrail. Anthony, welcome to the program.
Cheers, Paul. Thanks for having me.
So the Fed, this is where it all comes together. They have a two-day retreat. This is where all the governors get together. What are your expectations? What do you think the market will be waking up to or listening to on Friday when we get a bit of a debrief on the Jackson Hole meeting?
Yeah, I mean, it's known as Glastonbury for central bankers for a reason. So the market fully focused on what Chair Powell may say, reading the tea leaves and trying to understand what the path of interest rates might be for the US Federal Reserve going forward. Now, there's a lot of debate in the market at the moment following the last meeting of the Federal Reserve, where some analysts and some market participants thought that potentially the US Fed might take their foot off the brakes a little bit and not tighten interest rates by as quickly as the market had been anticipating. And we've had a big run up in equities, global equity markets since. So some Fed speakers, some of the members of the committee have come out saying, no, you're wrong. We're going to keep hiking interest rates while ever inflation is high and not declining fast enough. So that's really what the markets are focusing on this week. What will Jay Powell say? Will he be more aligned with the Fed speakers or potentially suggest that we're getting close to the end of the Fed rate hiking cycle?
After saying that, what's your view?
I think the Fed keeps hiking until the end of the year. Whether it's
so 0.5% next time, 0.75%?
They're probably going to hike by 0.75% at its next meeting on the 22nd of September. There's a couple more meetings before the end of the year, at which point they will stop around 3.5%. Now, the big difference now, which is important for equity investors, is that you're going to see interest rates plateau. So they're not going to quickly reverse. Even if inflation starts to decline back to more manageable levels, those time periods of ultra low interest rates, they're gone. So the market going forward will be a lot more dispersed and a lot more about active investment management rather than simply piling into cheap ETFs and hoping the rising tide lifts all the boats.
Well, you're an active fund manager, so you would say that. So
well, of course, but they're very complementary. Yeah. But again, too often you've seen that investors have piled into passive exposure and they've had unintended exposures, say some of those really growthy type names that have led the sell-off over the last
So the rally
months.
that we've seen since sort of mid-June, we've had a pretty strong July, pretty good week last week until the market got a little nervous on Friday, and I guess it's going to be nervous this week a little bit. Are we going to look back, is that going to be, was June the bottom, do you think? Or do you think we're going to look back and this is just a bit of we could get a retest? In other words, the sort of rally was off an oversold market, maybe it's a little bit of a correction to the bear market. What's your take on it at the moment?
Yeah, I think June was really levels of peak bearishness in terms of sentiment. People were extremely negative, particularly given interest rates being hiked, inflation very high. I think going forward, what we're likely to see is not reaching those levels of peak pessimism again, but a market which is really trending sideways. And as I mentioned, the reason for being so carefully allocating in capital markets is there will be winners and there will be losers from this environment, particularly a world where the cost of interest rates is higher.
Yeah. So, I mean, your idea about sort of 3.5% Fed rate, I mean, that's the bond market in the short part of the curve in the US is almost there, right? The longer end's a bit more bullish. So, is the market got to do you think the market's going to have to price in just slightly higher interest rates still? If we had too much of a rally in the bond market and maybe the equity markets at the moment?
Yeah, I mean, the long end of the yield curve in particular is really focused on recession and how shallow or how deep it's going to be, and how the labour market responds. How much will unemployment rise and therefore growth slow as consumption starts to weaken. And that obviously has an impact on the outlook for equity markets as well. So what I anticipate is we'll likely see some stabilisation in yields, potentially the curve flatten rather than invert meaningfully, particularly at the long end of the curve, but the short end, those short maturities, that's likely to remain at these levels.
Okay, so maybe a quieter overall market, but it doesn't mean that individual stocks won't be doing a lot of things.
Exactly, yeah.
So let's just bring it back home locally. So we're obviously reporting season is a really big thing in our market because company profits are ultimately what you buy when you buy a share price. What's Firetrail's view in terms of how reporting season is going so far?
Yeah, I mean, we've seen a lot of companies actually beat consensus expectations or analyst expectations. So the earnings season, the results season has been pretty good relative to expectations. And as I mentioned, expectations weren't particularly great to begin with. So earnings have been good, but a lot of companies are really reporting that the cost pressures have risen significantly. And companies are also guiding going forward to a much more challenging environment, as you would expect. So there isn't much by the way of forward guidance from companies. A lot of them are hesitating in terms of being too clear on what the future might hold going forward. So it's really a case of wait and see, and potentially the Q3, Q4 earnings results might be a bit closer to what analysts had been expecting in terms of a slowdown in terms of the outlook, which is exactly what you would expect when interest rates are rising and the economy is slowing, particularly the global economy.
Yeah, I thought, look, I haven't seen the data, but I thought some of the companies would be even more conservative, right? I mean, it's very hard to think you're in a position of being a CEO on a board and you've got to talk about inflation and recession and slowing economies. We don't know what the pressures are. You think you'd be just fairly conservative on your guidance, but I mean, I guess it's probably tracking okay in my view, but I thought we'd get even more conservatism from some of the companies. Yeah,
I mean, if you think about the makeup of the Aussie market in particular, we're benefiting from high commodity prices, even though they've come off to some extent. So the Aussie equity market, big allocation or big weight towards basic materials resources. That's done pretty well if you talk about the behemoths. And in terms of the banks are still reporting very, very low loan loss rates, which is a reflection of
negative bad debts, right?
Exactly. So a reflection of ultra low unemployment. So unemployment only 3.5% in Australia, extraordinarily low. So the question mark for investors in the big banks going forward, so whilst they are throwing off a big dividend yield, the question mark is, in that slowing economy, an environment where rates are rising, house prices are falling, what should the banks start to consider for loan loss provisions and the extent to which defaults may pick up from their lending books?
Yeah, okay. All right, now I want to talk about a couple of interesting stocks that you like, particularly in the global portfolio. Probably names that we aren't familiar with, but they're doing some interesting things. So one of the ones you were talking to me about off camera was around this in the diesel fuel business, but green diesel. Is that right? Or sort of just go through a couple of these companies that I think local investors might like to think about.
Yeah, Paul. So the top selling vehicle in Australia for the last 5 years has been the Toyota Hilux Ute. And if you're a tradie and you own a Toyota Hilux, you're probably sick to death of hearing about the electric vehicle revolution. And
you want that power, right?
You're hardly going to fit your tools into the Tesla, for example. So what we've done at Firetrail is find a way that the ute drivers of the world can drive their diesel engine, internal combustion engine vehicles but have a 95% less carbon footprint and 60 to 90% less greenhouse gas emission output. And that's via renewable diesel. So the company we've invested in my fund, the Firetrail S3 Global Opportunities Fund, is a company called Darling Ingredients, listed on the New York Stock Exchange, over 100 years old, and they make renewable diesel from used cooking oil.
Right.
So they have relationships with 200,000 restaurants across America. They go in and they extract the used cooking oil and they produce renewable diesel from it. They also use animal offcuts. They separate the fat and the protein, they render it down, and they can make renewable diesel from animal offcuts as well. So typically 50% of a meat carcass is thrown away after you eat your sirloin, your T-bone, your beef cheeks. And this is what Darling Ingredients does. And the great way in terms of getting exposure to Darling Ingredients is the renewable diesel price is benefiting from the US Inflation Reduction Act, which has just passed through. Biden's just passed it, almost half a trillion of stimulus into the US economy. There are subsidies in there to produce renewable diesel. So you're talking about $1 a gallon for renewable diesel, $1.60 a gallon for renewable airline fuel. And that's a company, Darling Ingredients, really benefiting from high energy prices, but you don't have to own the traditional fossil fuel extractors like an Exxon Mobil or a Shell to get exposure to the high energy price complex. And that's one thing that we're investing in today.
Thanks, Anthony. That sounds like a really interesting company. That was Anthony Doyle, the head of investment strategy at Firetrail Investments. Well, we're into the second last week of reporting season. This is a big week, but about halfway through, we're starting to see some trends in terms of what the companies are telling us and just what the outlook is for company earnings. Joining me now to discuss that is Raymond Chan. He's the head of the Asian desk with Morgans. Raymond, welcome to the program.
Thanks for the invite.
What's your overall take on reporting season? Is it a boomer out there, or what are we seeing?
We're seeing company bought in line with expectations, so they're sort of meeting the expectation. However, if we compare all the recent reporting season, we certainly seeing far less company beating the market expectation. Not that bad over there for those who rely on or would love to receive the dividend income, because the dividend growth is pretty much in line with the historical trend. And the all important, the FY23 outlook, again, we don't see significant earning revision here. What I mean here is, sector to sector basis, we still seeing a bit of earning upgrade on the value and financial stocks and continued downgrade on the high PE stocks. But net, we're seeing the FY23 stay at around the previous level before we going into the reporting season. That's why the market sort of gone back to the fair value that we have, but then struggle to move a lot higher, because now the market is trading around our fair value, which is 7,100. A lot of installs still sitting on a lot of cash. I think what happened is the sell side, as I mentioned before, the sell side been pretty conservative going into the reporting season, but they are they're even more bearish going into the AGM season. So sort of holding quite a fair bit of cash and want to see what happened to the AGM season in October.
And is that because this time of the we're very early into the year, 5 weeks or 6 weeks into the year, lots of discussion around higher interest rates, inflation, cost pressures, that companies are sort of, being a bit conservative in terms of their guidance and how they're thinking about FY23?
Yeah, this is exactly right. We hear from a lot of companies like JB Hi-Fi, realestate.com, Super Retail Group. They are sort of telling us, the inflationary pressure, it got mentioned, but it yet to bite into the earnings. And then, we have, other retailer telling us yeah, there has been, significant supply chain disruption. However, they're seeing the easing of this disruption going into the second half of this financial year. So those are the two things that make the market think, things may not be as bad. But equally, as you suggested, it could be because this is the beginning of the financial year. They have yet to see a meaningful impact of all these things happening. I think the most notable one would be from Combank. Combank, they sort of suggested, yes, the credit environment is pretty stable. However, they start to see the home buyer, the homeowner, cutting down on their credit card spending. So this is, very credible because they're the biggest credit card issuer in Australia. And they usually have the figures well ahead, surprisingly, well ahead of the RBA. So this is the indication they provided to us. So that could be an early sign.
Yeah. I mean, is there also now a bit of a trend that, and maybe it's a function of commodity prices, I don't know, and that sort of we get the reporting season starts okay, and then as you drag on, it just gets a bit worse. Is there sort of, we're now getting almost the two halves? The first half tends to be better than the second half. Are you any data to support that hypothesis?
Okay, with the reporting season, we normally see, I don't know if this is a trend or anything. With the reporting season, we normally see better quality result come up first. So according to the number of companies that under our coverage, around 35% of the company reported. And it's fair to say they are not as outstanding as before.
Yeah.
And I consider that already to be the good quality company. So the trend for future reporting season, as you mentioned, may not be as great. We may continue to see a deterioration of reporting season. However, of course, in Australia, we only got 2 reporting seasons. That's why the AGM season will be important. In US, we got 4 reporting. We got quarterly reporting. So we got more timely trend. However, if this reporting season, according to the 35% of the company that we have witnessed, the trend certainly not as strong as before. Yeah.
Okay, let's go to one of the companies that did report last week and is actually up today in a down market. That's CSL. It immediately reported the market sold it off, and then it bought it again on Thursday, and it sort of struggled to get through $300, and we're still not there. What's the Morgan view on CSL?
We maintain an ad recommendation on CSL. Obviously, to understand the CSL, as most of you would know, 75% of the earnings is from CSL Behring, which is the plasma-derived product. We treat a wide range of disease such as HPV, immunity disorder, blood clot, etc., etc. That plasma is collected by another division of CSL called CSL Plasma. Okay, so that's 75% of the earnings. And we have 25% of the earnings come from another division, the Seqirus. The Seqirus, which doing all the long plasma product, such as the influenza vaccine, that under very strong demand. So what happened when they announced the result? They say that FY22, while it meet the guidance, is actually below the market expectation. It's because of the plasma collection still constrained by the COVID. And the good news, of course, is they say the plasma collection now back to pre-COVID level. And then they also talk about the FY23 outlook is around 6 to 11%. That seems to be a bit on the low side. However, they did make a disclaimer, with last year welfare acquisition, they have yet to include that on their projection.
This is the V4 Pharma, or now CSL V4, they're calling it, right? The business, the Swiss business that's involved in kidney disease, yeah?
Exactly, and iron deficiency as well. And this is, of course, something CSL never sort of touched before. However, the one thing we have to look at is, plasma, they are not always have huge demand. There were a time, Paul can tell everyone, there were a time, plasma has a global oversupply. But what CSL did, back then, that was, I recall, it's 2004. They actually go out and acquire the competitor, and that make them become the biggest plasma player in the world. So with the acquisition that they make, they have yet to have meaningful information to confirm the guidance. They will provide some update to the market in October. So the market, when they look at it, 6 to 11%, maybe on the low side. However, if we include this new acquisition, that will quite easily get them back into the double-digit earning growth. So I feel this is the reason why after the initial sale of the CSL actually gone back up. And you rightly point out, it briefly touched 300, but yet to meaningfully break about the $300 magic mark.
Yeah. So you have an ad recommendation on the stock. I mean, as you say, as you mentioned, it's struggling to get back through $300. I mean, do you think it's a buy right here, or what would your advice be to potential medium to long term investors?
I guess different people have different view, and they should always seek the advice from their advisor. However, CSL is a growth-oriented stock, paying very little dividend, so you're buying for growth. So for growth with a good level of tolerance, I think CSL is a whole to buy. Of course, it's better buy if it's below 290, because our target price is only around $320. So now, as of today, the upside is less than 10%. So someone really have to have a long-term view to buy now rather than to wait for the pullback. As I mentioned, AGM season is coming up. That could be market volatility that will allow us to potentially pick up stocks at a lower price.
Let's go to another part of the market. Let's look at the oil stocks, because we haven't had Woodside report, but we have had Santos. Santos looks incredibly cheap against Woodside, but it hasn't really been performing. So what's your take on Santos?
We spoke to the management last week after the result. We're actually quite comfortable with Santos. Okay, first of all, the result meet the market expectation. However, what happened here is the market would hope to have a bigger dividend. However, Santos decided to go for the share market buyback. And when a company go for a share market buyback, in my opinion, I love that, because the rest of the shareholder actually can benefit long term. However, some may argue, if you're buying back the market, and arguably this is not the bottom of the cycle for the oil and gas company, so they may think you may overpay a little bit on the share market buyback. And the other thing, of course, is the Alaska project, which of course is long call to Santos, but they still want to, they still plan ahead. They still want to go ahead and invest. Of course, the management suggests, this is not a must-have, but this is a very good project. They should continue to look into it. So I think the market think, they still try to work on the Alaska project, may extract a lot from the capital spending. But I guess what the market failed to see is there's a lot of positivities on the result. First of all, the PNG LNG, they've been talking about selling it down. Now they're very comfortable and say, they will able to sell the 5% of the next couple of months. I think they say few months, not couple of months. I think they say the few months. And announce an increased share market buyback and the potential to sell. This means they're quite confident they'll be able to sell this 5%. It's not the PNG LNG project not good, but it's just too big of the overweight in the portfolio. Yeah. So selling that, I think, is provide good price catalyst for Santos. Another thing, I think that eventually, with the right price, Santos will press a button and sell the Alaska project, which I think at least two catalysts in front of us for patient investor, who don't mind to sit with the oil and gas company and see for the long term.
And your target price and recommendation on Santos at the moment?
Yeah, the target price is around the $8 mark. We have an ad recommendation in Santos.
Okay, so an ad on Santos, an ad on CSL, both potentially for the long-term investor. But look, we have to keep on watching reporting season because we've got 2 more important weeks to go. But sounds like for your view, it's just a little bit on the soft side, but maybe that's companies being conservative looking ahead, given the, I guess the outlook is a bit challenging in that regard. So anyhow, look, great to catch up with you, Raymond. Thanks for sharing those views.
Thank you for the time. Appreciate it.
That was Raymond Chan, the head of the Asian desk at Morgans.
And that's the show for tonight. Thanks for joining us. I'll see you on Thursday. And remember, if you want to read that story of mine, go to Switzer Report, switzerreport.com.au.